Hi. Now, the Federal Reserve is scheduled to meet on September 20th and 21st to discuss policy rates. There are three things I think investors should pay attention to. First, we expect the Fed to raise rates by 75 basis points to 3 to 3.25%, and this will be in line with market expectations. The strong August job numbers allowed the central bank to keep its policy priority focused on cooling inflation. While headline inflation is starting to come down due to decline in gasoline prices, core inflation remains sticky, especially shelter and rental costs. The question becomes what the Fed would do with interest rates in the next few meetings, especially in November and December. Second, and probably the most important thing, is the latest summary of economic projections. In the June forecast, the median forecast for policy rates for the end of 2022 and 2023 was 3.4% and 3.8% respectively. The 2022 number is likely to be revised higher since we still expect rate hikes in November and December. But the key is whether the end 2023 forecast will be revised significantly higher and indicate that the peak of policy rates could be much higher than current market expectation. In June, its core personal consumption expenditure deflator or PCE deflator projection is much lower than policy rates by the end of 2023, implying a positive real policy rate. If the FOMC members are expecting inflation to remain elevated in late 2023, then it might need to revise up the policy rate projections too. Overall, we believe the risk of a substantial upward revision to inflation and policy rates for 2023 is low. Finally, comments from Fed Chairman Jay Powell are going to be closely monitored as well. We'll be looking out for indications whether the Fed will be raising rates in the smaller steps in the next few meetings. Given that policy rates would be above neutral, it makes sense for the Fed to be less aggressive. His assessment of the economy will also play an important part in driving market expectations.